Most people know they need life insurance, but when they actually go to buy it, they hit a wall. Term or whole life? The insurance agent is pushing one direction. The internet is telling you something different, and the policies themselves are written in language that seems designed to confuse you. By the end of this video, you'll know exactly what the difference is, which one most people actually need, and which one the insurance industry would rather you buy. Let's start with term life insurance, because it's the simpler of the two. Term life is pure protection. You pick a length of time, 10, 20, or 30 years. You pay a monthly premium during that period. If you die during that term, your beneficiaries receive a tax-free payout. If you don't die during that term, the policy expires and you walk away with nothing back. That last part sounds like a bad deal. You paid for years and got nothing. But here's why that thinking is wrong. You also paid for car insurance for years and never filed a claim. That's not a bad deal. That's insurance working exactly as it should. You were protected the entire time. You just didn't need it. Now here's where term life gets really attractive: the cost. A healthy 30-year-old non-smoker can get a 20-year term policy with a $500,000 death benefit for somewhere between $20 and $30 a month. That's less than $1 a day to ensure that if something happens to you, your family doesn't lose the house, can't pay the bills, or has to completely change their lives overnight. Term life is cheap because it's simple. The insurance company is making one bet: that you'll outlive your policy. Most people do. That's how they make money. And that's why they can afford to offer you significant coverage for a small monthly payment. Now let's talk about whole life insurance. And this is where things get more complicated. Whole life insurance covers you for your entire life, not just a fixed term. As long as you keep paying premiums, your beneficiaries will receive a payout when you die, no matter when that happens. But whole life also has a second component that term life doesn't have, something called cash value. Every month when you pay your whole life premium, a portion of that payment goes into a savings account inside the policy. That cash value grows over time at a guaranteed rate. You can borrow against it while you're alive. You can withdraw from it. Some people use it as a financial planning tool. Sounds better than term, right? Here's the catch. Whole life insurance costs 5 to 15 times more than term for the exact same death benefit. Let that sink in for a second. That same healthy 30-year-old who could get $500,000 of term coverage for $25 a month would pay somewhere between $200 and $400 a month for the same $500,000 whole life policy. So what are you actually paying for? You're paying for the lifelong guarantee. You're paying for the cash value component. And if you're being honest, you're also paying for the significantly higher commission that the insurance agent earns when they sell you a whole life policy instead of a term policy. That's not an accusation, it's just math. Whole life commissions are dramatically higher than term commissions, which is why whole life gets recommended so aggressively. That doesn't mean it's always the wrong product. It means you need to understand the incentive structure before you take the advice. So who actually needs whole life insurance? Genuinely, a small percentage of people. Whole life makes sense in specific situations. If you have a lifelong dependent, such as a child with a disability who will need financial support after you're gone, whole life guarantees that support regardless of when you die. That's a legitimate use case. If you've already maxed out your 401k, your IRA, and every other tax-advantaged investment account available to you, the cash value component of a whole life policy can serve as an additional tax-deferred savings vehicle. That's also a legitimate use case, though it applies to a very small percentage of Americans. And if you have a large estate and complex estate planning needs, whole life can play a role in minimizing estate taxes and transferring wealth efficiently. Again, legitimate. And again, applying to a small percentage of people.
For everyone else, and that means most people watching this video, term life insurance is the right answer. Here's the approach that most financial experts agree on. Buy a 20 or 30-year term policy. Get enough coverage to replace your income for at least 10 years. A common rule of thumb is 10 to 12 times your annual income. If you make $80,000 a year, you want somewhere between $800,000 and $1 million in coverage. Then take the difference between what you would have paid for whole life and what you're actually paying for term, and invest it. Put it in your 401k, put it in an index fund, put it anywhere that gives you real market returns over time. This approach, known as buy term and invest the difference, almost always outperforms the cash value growth inside a whole life policy over a 30-year period. Let's talk about one more thing before we wrap up. What happens when your term expires? This is the question people don't think about when they're 30 years old buying a 20-year policy. At 50, your term runs out. Do you need coverage anymore? In many cases, no. If you've been investing and saving for 20 years, your kids are grown, your mortgage is paid off or nearly paid off, and you've built enough assets that your spouse could live comfortably without your income, you may not need life insurance at all at that point. The need for life insurance is highest when your dependents are most vulnerable and your assets are smallest. That's usually your 30s and 40s. By your 50s and 60s, the calculus often changes. If you do still need coverage at the end of your term, you can buy a new term policy, though premiums will be significantly higher at 50 than they were at 30. That's the trade-off with term. So let's bring it all together. Term life insurance is cheaper, simpler, and for most people, provides exactly the protection they need during the years they need it most. Whole life insurance is more expensive, more complex, and appropriate for a specific set of circumstances that apply to a minority of people. If an insurance agent is pushing you hard toward whole life, and you don't fall into one of the specific categories we discussed, lifelong dependent, maxed out tax-advantaged accounts, complex estate planning, it's worth asking a second opinion from a fee-only financial advisor who doesn't earn commissions on what they recommend. The right life insurance policy is the one that protects your family at a price you can actually afford to keep paying. For most people, that's term. The information in this video is for educational purposes only and does not constitute legal, financial, or professional advice. Always consult a qualified professional before making any decisions. If this helped you understand the difference, subscribe. We break down insurance and financial topics in plain English every week. No jargon, no sales pitch, just the facts.